Canada is signaling a shift its own governments have described for a generation without carrying out. And this time, the language from Ottawa is unusually direct. A minister in Prime Minister Mark Carney's cabinet said this week that Canada will not remain dependent on American markets. A statement arriving days before a threatened round of 50% United States tariffs is scheduled to take effect on August 19, 2026. President Donald Trump's administration set that date. Canadian negotiators are still in Washington trying to prevent it. And underneath the diplomacy, numbers released on August 7th suggested the two economies may be moving in different directions. The question is whether this is rhetoric or the beginning of a genuine structural pivot. Why does that sentence matter? For decades, the standard Canadian response to trade pressure was to absorb the shock, negotiate an exemption, and return to business as usual. Framing dependence itself as the problem treats the dispute not as a storm to wait out, but as the trigger for a redesign of where Canadian goods go. That is a far larger claim, judged over years rather than weeks. Start with what is actually scheduled. Last month, the U.S. president announced he would use Section 338 of the Smoot-Hawley Tariff Act of 1930 to apply 50% duties to roughly $20 billion US worth of Canadian exports, including alcohol, dairy, and electronics, effective August 19th. The scope is about 5% of Canadian exports to the United States, covering goods from alcohol to hockey sticks to cement, narrower than the sweeping tariffs of the past 2 years, but the legal instrument is unusual, and Ottawa treats it as a serious escalation. The negotiations are active and unfinished. Canada-U.S. Trade Minister Dominic LeBlanc and Chief Negotiator Janice Charette have held repeated rounds of talks in Washington with the U.S. Trade Representative. They and Canada's ambassador briefed provincial and business leaders on August 6th. Talks have intensified since the deadline was announced on July 20th. Candice Lang, president of the Canadian Chamber of Commerce, who attended, said the message was that meaningful progress had been made toward an interim deal, an assessment from a business group, not a confirmation from either government. Carney addressed the talks on August 5th. He said negotiators were focused on all strategic sectors, including automobiles, and that his goal is a comprehensive agreement rather than a narrow fix. He also wants removal of the sector-specific tariffs imposed under Section 232, which affect Canadian steel, aluminum, autos, and lumber. Asked how likely he was to prevent the 50% tariffs, he offered only that they would see. That hedge is itself informative. Ottawa does not consider the outcome settled. A retaliation question also hangs over the deadline. After meeting Canada's premiers in Charlottetown, Carney said everything would be on the table if no agreement is reached, while making clear Canada would not retaliate before the tariffs take effect. No list of targeted American products has been announced. This is stated readiness, not policy. Now the numbers, where the divergence argument is strongest. On August 7th, Statistics Canada reported employment rose by 75,000 positions in July, a gain of 0.4%, while unemployment fell a tenth of a point to 6.4%, the lowest in 2 years. Ontario led with 52,000 additional jobs, followed by British Columbia, Manitoba, and Nova Scotia. Gains spread across wholesale and retail trade, finance and real estate, professional services, and construction. The details matter as much as the headline. The result came well above forecasts clustered around a 20,000 gain, and unemployment fell even as the labor force expanded by roughly 60,000, meaning the economy absorbed new job seekers rather than losing them. Average hourly wages rose 2.8% year over year to $37.17, a moderation from 3.3% in June. Slower wage growth alongside stronger hiring is a mixed signal, and Canadian economists have been careful not to overstate it. That caution is warranted. Average monthly job growth in Canada for 2026 to date is a modest 10,000 after a weak start, and 6.4% unemployment still points to real slack. Public administration shed 15,000 positions in July, and agriculture roughly 9,600. Youth unemployment at 12.6% was virtually unchanged. This is a labor market improving from a difficult period, not a booming one. The contrast with the United States gives the story its edge. The same day, the U.S. Bureau of Labor Statistics reported non-farm payroll employment changed little in July, declining by 23,000 after average monthly gains of 34,000 over the prior 12 months. The unemployment rate edged down to 4.1%, but largely because fewer people were working or looking for work, and average hourly earnings were nearly flat, bringing 12-month wage growth to 3.2%, the lowest since May 2021. One further detail. May payrolls were revised down by 66,000 and June by 37,000, meaning employment across those months was 103,000 lower than previously reported. The labor force participation rate fell to 61.4%, a level not seen in more than 5 years. Forecasters had expected a gain of roughly 83,000. Instead, the report described a stalled labor market. Still, 1 month does not make a structural trend. The two countries define unemployment slightly differently and differ enormously in size. One strong Canadian report and 1 weak American report do not prove decoupling. They provide a data point supporting the argument Ottawa is making, which is why the timing has drawn attention. There are also claims of capital moving north as investors hedge against American policy volatility. Treat that carefully. Flow data lags, is revised, and short-term moves reverse. What is clearer is that policy uncertainty is now priced by investors, and that Ottawa is openly courting foreign capital. Whether that has produced a durable reallocation is unsettled. Energy is where the shift is easiest to see, the clearest illustration of dependence on a single buyer. Natural Resources Minister Tim Hodgson said earlier this year that Canada used to send 98% of its energy exports to one country and is now committed to diversifying. Crude oil was nearly 20% of the value of all Canadian goods exports in 2024, and more than 95% of it went to the United States. That is the scale of the concentration. The most concrete step came in late July, when Canada announced a second major agreement to export liquefied natural gas to Europe, roughly a week after the U.S. president signed the order imposing 50% tariffs on a range of Canadian exports, energy excluded. In an accompanying briefing note, Ottawa said it aims to sell 55% of its natural gas exports to customers other than the United States by the middle of the next decade. Consider the starting point. In 2024, countries other than the United States took just 1/100th of 1% of Canada's natural gas exports. Moving from a rounding error to a majority share within a decade needs terminals, pipeline capacity, long-term contracts, and financing on a scale Canada has not attempted here. Targets are statements of intent, and the record on large energy infrastructure suggests timelines slip. Global conditions have made those cargoes more attractive than a year ago. European buyers face supply disruption compounded by the closure of the Strait of Hormuz, which has left tankers blocked and pushed more countries to seek alternatives to Qatari liquefied natural gas. Hodgson calls this Canada's opportunity, telling one financial newspaper the world urgently needs a reliable supplier. That is a sales pitch. The response will be measured in signed contracts. Asia is the second front. Hodgson says Canada is building pipelines to the West Coast, 3 completed and more under consideration, and could supply crude oil, liquefied natural gas, and uranium to India, which he calls the world's fastest growing source of energy demand in coming decades. Canada began exporting liquefied natural gas to Asia in June 2025, and the Trans Mountain expansion opened a direct crude route to the Pacific, though most shipments to India still move through the U.S. Gulf Coast. Critical minerals are the third pillar, and here the effort is further along institutionally. At an industry convention in March 2026, Hodgson announced 30 federal partnerships with 12 allied countries under the Critical Minerals Production Alliance, which he said would bring $12.1 billion in spending on mining and processing projects in Canada, with the broader initiative directing roughly $18.5 billion to the sector. Carney launched the alliance to reduce allied dependence on higher risk suppliers. An international framework is building around this. Canada secured agreement on a critical minerals action plan during its 2025 presidency of the G7, and France carried that work forward at the Evian summit in June 2026, where leaders committed to cutting reliance on any single supplier for rare earths and permanent magnets outside G7 and partner countries to below 60% by 2030, with ministers asked to set diversification targets for other critical minerals before the end of 2026. These are commitments, not completed transitions. To understand why Ottawa is moving this way, look at the previous 2 years. Aluminum costs for American buyers have risen more than 50% since the United States raised its aluminum tariff to 50% in June 2025. And Canadian steel, aluminum, autos, and lumber all face sector-specific duties. The relationship chilled politically after the 2024 election, with many Canadians cutting purchases of American products and travel south, while the president repeatedly floated Canada becoming a 51st state. That friction fed into economic policy. Carney argues Canada's close ties with the United States have shifted from a strength into a vulnerability, citing disputes and tariffs that created uncertainty in autos and steel and made investment decisions harder. His response? Stronger internal trade, more investment, expanded clean energy capacity, and a wider set of trading partners, paired with a measurable promise. That promise is to double Canada's non-American exports within a decade. Carney has made diversification a centerpiece of his agenda, logging 26 foreign trips in his first year in office. Ottawa also created a strategic exports office to connect Canadian companies to international buyers, which began work as the August deadline approached. Finance Minister François-Philippe Champagne has separately promoted Canadian critical minerals, liquefied natural gas, and nuclear technology to European counterparts as contributions to European energy security. Now the counterargument, which is serious. Trade analysts and business leaders describe a paradox. Canada's ability to attract foreign investment and new agreements depends heavily on the very American relationship it wants to depend on less. And officials acknowledge that preferential access to the U.S. market remains the main attraction for prospective partners. The door Canada is walking away from is part of what makes the House valuable. The Prime Minister has been careful about how far he takes the decoupling argument. Earlier this year, he rejected using energy or critical minerals as leverage, said Canada is not discussing halting that trade, and stressed that Canadians honor contracts. But he questioned whether Canada should deepen energy integration with a partner that treats it as leverage, adding that if mutual interest is absent, other options exist. Refusing to weaponize exports is not the same as deepening reliance. The two positions are clear. Ottawa wants meaningful reduction of the Section 232 tariffs on steel, aluminum, autos, and lumber in one comprehensive agreement. And negotiators signal they can address the main American complaints if those duties come down substantially. American officials keep raising Canada's remaining retaliatory measures, particularly decisions by several provinces to pull American-made alcohol from provincial liquor retailers. That is where federalism complicates the file. The provinces are not a side issue. They control those alcohol restrictions and the procurement rules steering purchasing away from American goods. So Ottawa cannot simply trade them away at the table. Premiers agree on a united front, but continuing disagreement over energy policy shows how fragile that unity could be if talks fail. Any interim deal needs provincial cooperation to hold. Reporting on one proposal conflicts. A national newspaper reported on August 4th that the two sides were discussing a revived idea from last year, a tariff quota under which a defined volume of Canadian steel and aluminum would enter the United States at a lower rate. Two government sources told the public broadcaster this did not reflect the state of negotiations. Both cannot be correct, and neither government has confirmed terms. Who is affected if the measures proceed? Immediate exposure sits with exporters of the targeted goods, alcohol producers, dairy operations, and electronics manufacturers. Beyond them, workers and firms in steel, aluminum, automotive assembly, and forest products remain under the existing sector tariffs Ottawa wants removed. Communities built around a single plant feel these decisions faster than national statistics register them. And provinces carry much of the response. American businesses and consumers are not insulated. U.S. industry still relies heavily on Canadian metal, even after tariffs pushed aluminum costs sharply higher. And Carney argues a mutually beneficial deal would lower costs for American firms. If talks collapse, the effect shows up in everyday purchases, from a bottle of beer to a new truck. That is the political constraint on the American side. Energy is where mutual dependence is most acute. Canadian exports of oil, natural gas, and electricity to the United States totaled nearly $170 billion in 2024. And one major Canadian bank found tariffs on Canadian crude could raise American gasoline prices immediately by roughly 30 to 70 cents per gallon. That is one reason energy was excluded from the newest tariff order, and why Ottawa calls the sector its strongest card. There is a monetary policy dimension, too. Canadian bank economists note that with tariffs possibly arriving on August 19th and energy prices volatile, downside risks remain. Some now expect the Bank of Canada to hold its rate steady for the rest of the year. Federal Reserve policymakers are divided, with several officials recently arguing for an increase as soon as September if inflation does not ease, after the committee voted 9-3 to hold. Does any of this mean Canada is cutting the United States off? No, and nothing available supports that reading. The United States has historically taken about 3/4 of all Canadian goods exports, and that cannot be unwound by announcement. What has changed is the direction of new investment, infrastructure, and contracts. A pivot at the margin can matter enormously over a decade while barely registering in one quarterly trade report. The physical constraints are real and slow. Carney has spoken of unleashing very large sums in energy and port infrastructure, citing public examples, reinforcing the Port of Montreal, the Contrecoeur development, and effectively creating a new port at Churchill, Manitoba, to open up liquefied natural gas and critical minerals. Ports, terminals, and pipelines take years to permit and build. Announcements take a morning. Capacity does not. Domestic politics will also shape how far this goes. Large pipeline proposals have repeatedly run into costs, regulatory complexity, and organized opposition, including from coastal First Nations in British Columbia, alongside an existing tanker ban on the province's northwest coast. Companies often chose cheaper routes south instead. Diversification needs foreign buyers and domestic agreement on how to reach them, which has never been easy to assemble. Separate what is confirmed from what is not. Confirmed. July labor data in both countries, the scheduled August 19th tariffs and their legal basis, the Washington negotiations, the second European liquefied natural gas agreement, the 55% gas export target, the critical minerals partnerships, and Carney's stated willingness to consider countermeasures. Not confirmed, the contents of any interim deal, whether the tariffs take effect, the quota proposal, and whether the diversification targets will be met. What happens next falls into a few paths. One is an interim arrangement before August 19th that suspends or narrows the new duties while broader talks continue. The objective business representatives were briefed on. A second is a short delay without substance, which Ottawa says it does not want. A third is that the measures take effect, prompting countermeasures under domestic pressure. Each depends on decisions not yet public. Beyond this deadline sits a larger process, the scheduled review of the Continental Free Trade Agreement, which both the tariff dispute and the diversification strategy will feed into. Hodgson calls energy, electricity, forest products, and minerals Canada's best assets in that renegotiation. If Ottawa can show genuine alternative markets by then, its position changes. If not, the dynamic looks much as it always has. The significance of this week is not that Canada has stopped trading with the United States, because it has not and will not. It is that a Canadian government has publicly defined dependence itself as the problem, attached measurable targets and infrastructure spending to that definition, and done so in the week its labor market outperformed a stalling American one. Those facts are related in timing. Whether in substance is the open question. What I am watching is straightforward. Whether negotiators produce anything before August 19th, and whether it is comprehensive or partial, whether Ottawa names specific countermeasures if the duties proceed, whether the provinces hold a common position, and whether the contracts, terminals, and processing projects announced this year convert into shipped volumes. Statements can be reversed. Signed contracts and built infrastructure are much harder to undo. Thank you for watching this report on Canada's push to reduce its dependence on American markets and the 50% tariff deadline facing both countries. The story is still moving, and decisions in the next several days could determine whether the two governments reach agreement or enter a new phase of the dispute. Subscribe and turn on notifications for verified updates.